Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and today we're taking a look at the AES Corporation, ticker AES. They are a utility company. Things are a little different with them, and I found them again searching through the S&P 500, looking at some of the cheaper stocks on the list. And this one stood out because they're currently trading for $8.83, but they've been as high as $27.81 in the last 52 weeks, as low as $8.21. So they're really close to their 52-week low. Worth taking a look, seeing what's going on. I mean, from an earnings standpoint, they're definitely undervalued. From a dividend standpoint, they look to be pretty undervalued. Cash flows have never been their strong suit, and neither has the balance sheet. No surprise for the sector that they are in. Really, it's one investors treat different. It's treated like a bond proxy where you get stability and a dividend. Because when you look at these revenues, what you see here is very flat. I mean, there was a big jump from 21 to 22, but aside from that, not a whole lot of movement. With the money behind the scenes, though, you can see the EBIT has had some really good growth, and the net profit has made a recovery from negative up to a positive. But the gross profit's kind of been on a downtrend. So getting back to the summary, that mostly covers things. I mean, they have room to grow their dividend. It's really high compared to what it's been historically. They came in with pretty small growth recently. I mean, you can see the trend here. Big jump from 21 to 22 and just small steps since then. Why is the market so worried? Pretty good sign here. A decent pullback in the revenues, a drop of 4.4% according to analysts this year, and next year a recovery up to 1% growth. But if we take these numbers into account, we're looking at something either flat or a downtrend in revenues, and that's not really what you want to see for a company. Share count, they continuously issue shares. I mean, I get it. That's where you get money, pay off that debt, keep operations going. In real estate and utilities, it's pretty reasonable. It's definitely not how I'd like my stocks to be, though, because that 2% is diluting your position by 2%, but now they're paying out that additional 2% of dividend across more shares. They're paying out a greater dividend and you don't even see any sort of return on it. In fact, your position's diluted. Cash flows, I mean, they've been in rough shape. Being negative value here actually is positive, bringing them more positive. Assets, 12.8, 7.3. This last year it was 6. So low single-digit growth seems reasonable here. Liabilities, similar story, 11.8, 5.4, 2 in this last year. So 2 to 3 is definitely reasonable. A dividend growth rate of 2%. And then small margin growth. I mean, the margins are decent as is. The gross was down a bit this last year, but the net was up. So maybe even 0.5% is too generous, because that does take them pretty high. And with this thesis, we're looking at average annual growth of 6%. Once you factor in the dividend, you're looking at 13.7%. So it is outperforming the market over the next 3 to 5 years if it is able to achieve the fair value, that $13. When we look at the price chart, I mean, if you take the cash flows out, you can see that all valuations are clustered very closely together. Cash flows really dragging down the fair value, but it was trading at a pretty good price, $23.78, where the dividend and the balance sheet all kind of agreed on that price. And back in 2022, again, around $20 to $25. We saw a bit of divergence this last year across things, and now not much growth in the dividend, a pullback in the earnings. Balance sheet up just barely. I mean, I wanted to say no to this thing with the negative revenues and the growth in the share count, but it's at such a value that I'm almost considering it. I mean, it seems to be the issue here is a very rough balance sheet in a high interest rate environment. So they're going to see probably a decent growth if interest rates go down. It'll benefit them a lot if they can refinance some of that debt, especially dealing with solar, because that's not going to pay for itself super quickly. It'll pay for itself over time. I mean, I don't know that this is a buy the dip. It'll be a recovery play once they start turning around. Once these revenue projections aren't negative, I don't think that they're going to slow down on the share count growth. I mean, it's not the end of the world, especially for what they do. But like, if this debt to equity can get below 10, and they can at least slow down a little bit on the shares, then I think it's more reasonable. But it's honestly tempting for me. So if you like dividends, I don't think it's bad. They definitely have the earnings to pay it out. It looks to be pretty safe for the sector they're in. That's where a lot of the value is at. If you like value and turnaround plays, it's tempting. It definitely is, but I'd want to see some more data to see that they're going the right way and not continuing the wrong way. So it's going on the watch list. I don't know if I'm going to buy it necessarily, but definitely if interest rates drop, I'll have to give it another look. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.